Welcome back, and it's time for a big story of the day here on Trading Hour, and that is RBI's proposed new norms on how large upper layer NBFCs are now going to be classified. And there are significant shifts that RBI is proposing that is going to have repercussions for a lot of existing NBFCs, starting with the big shift, which is earlier upper layer NBFCs would be classified as upper layer on the basis of various scoring models, which is parametric. It was based on qualitative and quantitative criteria. Now, RBI is supposed to scrap that and come up with a simple system, which is to look at the asset size. So if an NBFC's asset size exceeds 1 lakh crores, they will qualify to be an upper layer NBFC. The second change is that earlier, the top 10 NBFCs would automatically fall in the upper layer bucket. Now, that is proposed to be done away with. The third big change is that government NBFCs so far were not were not exempt from being classified as an upper layer NBFC. That also is proposed to be removed. However, keep in mind a lot of these government NBFCs have significant exposures to state government-backed projects, and therefore to ease that transition for them, RBI has also proposed to exempt the fully guaranteed state government exposures from the computation of their exposure limits to ensure that there is no breach in these limits as they transition. These are still draft proposals. Final norms will be drafted only after comments are invited by the 8th of May. Keep in mind, for an upper layer NBFC, the regulations are tighter, the capital exposure norms are tighter, there is greater disclosure requirements, governance requirements. So, a lot of these NBFCs therefore are going to be impacted. What happens to the fate of Tata funds? That has been the question. Well, not much changes because of these rules. It will simply now, still continue to depend on what RBI decides to do with their deregistration application. But for a lot of these government-owned NBFCs like PFC, RFC, IRIDA, HUDCO, etc., they could potentially be included in this list because their asset size far exceeds the 1 lakh crore threshold. But joining us today to discuss these proposed overhauls for the NBFCs are AM Karthik of ICRA and Sanjay Doshi of KPMG. Gentlemen, thanks very much for joining us here. Karthik, to begin with you, specifically on the government-owned NBFCs, the likes of HUDCO, PFC, RFC, etc., the state government exposures are significant. Even with the exemption that has been provided, do you think some of them could still be in breach? And secondly, and I'm talking about the likes of HUDCO that don't only have government-backed exposures, that don't only have government-backed exposures, and does it also effectively neutralizes, the stricter rules that come along with being an upper layer NBFC?
Yeah, hi, thanks. The government-owned NBFCs will easily qualify for the upper layer. There are two things which have come up. One is, the classification. This is the asset size, based on which all these entities will classify for the upper layer criteria. The exemption has been provided specifically for the concentration norm, which applies to an IFC depending upon whether it is in the middle layer or the upper layer. So the point that you talked about specifically on the state government related exposure and the exemption from a concentration norm perspective, which was applicable at the middle layer level, is also applicable now to the upper layer entities, which is the change that the RBI has done with the draft regulation. But more importantly, what has changed is that when an entity is moving from middle layer to upper layer, the concentration norms which are applicable for an IFC in the middle layer were 35% of tier 1 and 30% of tier 1 and 50% of tier 2 from a single and a group exposure point of view. So that will get tightened when they move to the upper layer entity. So the group exposure norms, which were about 50% of tier 1 when they were in the middle layer, becomes 30% of tier 1 in the upper layer. But at the headline level, we don't estimate that to be a major concern at this point in time, because a lot of these entities do have a sizable guaranteed exposures, state government guaranteed or the central government guaranteed.
Except IRIDA, Karthik, though. But Karthik, IRIDA has, I think, almost 71% private concentration exposure, not government. What happens to them?
So we'll have to look at it. Basically, most of them are significantly below the levels which are stipulated even now. So we'll have to see essentially what will be the impact. But headline should not have any major impact on any of these entities.
Sanjay, what is your reading? I mean, even the fact that government-owned NBFCs with these large exposures are getting all kinds of exemptions to ensure that that transition is easier. Does it uneven the playing field between government and privately held NBFCs? And overall, do you think just sticking to the asset size of 1 lakh crore as the threshold, does it risk diluting some of the risk sensitivity, the interconnectedness, etc., parameters that would have typically been looked at to qualify for tighter regulations?
Sure, Ritu. So, see, there are two parts to it. So, one is, of course, all those regulations is kept in mind with the systemic risk if any particular institution is bringing to the market, and hence how you really mitigate it. Now, when you look at this entire thing around, as you were putting it and as Karthik mentioned, around the state government loans, etc., right? So, there are two parts. One is the exposure norms, and second is the capital which the NBFC has to have to really cover from a capital adequacy perspective. From an exposure norms, anything which is guaranteed by the government or state government, I think the treatment is the same, whether it's for private or whether it's for public sector NBFCs, where they are excluded to the extent there is guarantee available. But for state government guarantees, there is a requirement for a capital to come in. So effectively, it's been there. And hence, is it going to really, this particular draft, if it becomes a regulation, is it really going to make a material change? The answer is no, definitely in a short to mid term. But longer term, I'm sure, I think slowly and steadily, there will be a direction where do you really need this kind of guarantees, or you really want to bring public sector entities and private sector entities completely to market factors. So that's the other perspective to it. But net, we don't really expect a major mid to long term change, mid to short term change in terms of any such transition or change happening.
But Karthik, the draft also speaks about the fact that there will be a proposed 5-year review cycle for the upper layer asset threshold, and currently out of the 15 upper layer NBFCs, it's only Tata Sons that is not in compliance with this 3-year mandatory listing norms. It is supposed to be listed by September. But now, do you see that with this, there have been experts who have told us that this would not impact Tata Sons, and they have options with them as well of declassifying themselves as an NBFC. Does that option still lie on the table for them? And if so, what can Tata Sons do otherwise to navigate this listing criteria?
I want to comment on the entity specific question, but it's up to the regulator and the entity to decide on how on the way forward. But going by this new regulation, it's completely dependent on the asset size, and the asset size qualification applies for Tata Sons. But we'll have to see how it is worked out. So it's specific, entity specific. I think it will be between the regulator and the entity to decide on how they navigate through this. But having said that, we'll have to look at the 5-year life cycle, which is applicable for any upper layer entity. So the transition which is applicable for an entity to be, once it is classified on upper layer, it continues to be in upper layer for a period of 5 years. And also there is an option at the regulator to look at entities which are moving towards upper layer. So entities which are not qualifying for upper layer but will become an upper layer definition maybe in the near term. So they typically tend to sensitize those entities. This is part of the regulation which is already there in place. So typically tend to sensitize and see what is the way forward if the upper layer becomes applicable for these entities over a period. So these are all discussions which happen between the regulator and specific entities, and thing which is completely between the two, and they decide on the way forward. So difficult to exactly comment on what will be the way forward for a specific entity that you brought about in the question.
No, we take that point, and periodically as the economy grows, as these entities grow, etc., these norms need to be revised as well. But one more point, Karthik, which as of now do you see outside of what is there in the upper layer and what has been discussed already in the unlisted space, do you think could make the cut in the very near future? Do you have any guesses out here, any calculated predictions that you can make?
All of them are listed which may qualify for this criteria at this point in time. So we don't see any unlisted entity which will make the cut. We'll have to see how the RBI transitions on the entities which are currently there in the upper layer category but may not necessarily make the cut of 1 lakh. They do have the time of till September 27, when the 5-year timeline lapses for some of them, and that the RBI and those entities which are currently upper layer and not possibly making the cut which the RBI is proposing on the asset size, they will decide on on the way forward. So not on the unlisted space which can make the cut and and not be listed at this point in time.
Sure, that's PNB Housing and Samman that are below that 1 lakh crore threshold, but keep in mind they have a 5-year window from 2023. So it's not that they will immediately exit, even if these guidelines are implemented as is. But Sanjay, a final question. Some of these smaller NBFCs that are perhaps significantly below or just below that 1 lakh crore threshold, do you think we could see some active balance sheet management to ensure they remain below it, for the time being, to avoid tighter regulations, especially, when it comes to bank-like regulations for these smaller NBFCs? Do you think they'll actively manage their balance sheet to avoid doing that?
So active management, I think slowly and steadily it's going to be a group level exposure. Means how do you actively manage is effectively, do you really want to go off balance sheet, which ideally people and especially larger NBFCs like to have loans on their balance sheet, number one. Number two is, can you split and have multiple NBFCs? Again, that has a lot of restrictions. So their ability to maneuver and keep the balance sheet size lower effectively will not work in a mid to long term. Short term, maybe they can try to do a bit. So the reality of life is for them to really accept it and start preparing to get into the upper layer NBFC. I think the other point which you all also highlighted is on, and if I don't want to go into specific entity as Karthik mentioned, is that the entire core investment companies, right, the CICs. How RBI is going to look at CICs which are really above that particular size of 1 lakh crores? Are they really bringing risk back to the market in terms of a systemic risk perspective, from a public funds perspective? So I think the decision making will really lie whether a CIC, however large it is it something which the group really wants to have or the shareholders wants to have effective control within their own subsidiaries and within their own groups, and hence they are not really bringing any kind of systemic risk to the market. So then should they be registered and hence should be an NBFC and hence should be an upper layer or not? So two aspects. One is, yes, anything which is slightly less than 1 lakh crores, be ready. Start getting your act ready in terms of preparing yourself for the tighter regulations which are going to come in if this becomes a regulation. And the second one for CICs is really make a decision whether they want to or they should become an NBFC or not if they don't have any risk from a public funds perspective.
Yes, and I believe the CIC are referring to as Tata Sons. We'll have to see what happens to their deregistration application. But Karthik, Sanjay, both of you, thanks very much for giving us your time here and helping us understand these important regulatory changes for NBFCs. On that note, we're going to slip into a short break, but when we return, we're going to discuss market technicals with Somil Mehta of Mirae Asset Share Khan and also discuss his stock trading ideas.